Hello and welcome to the Blue Collar Wealth Club. I am your host, Sheena White.
And I am Jerry Garcia.
So today we're going to talk about my favorite topic, cash flow. It's a good thing. Even on my website, it says revenue is vanity, profit is sanity, but cash is king.
No, this is a great topic. This is something that I love to hear you talk about because you're very passionate about it. You know tons about it, and I learn something every time I hear you speak on the topic.
So one of the things, we're calling this one cash flow conundrums. Like, how do we get that cash flow? So one of the biggest things I see a lot, especially with blue collar businesses, is accounts receivable. So people who owe you money. And you know what's really awesome is that you actually can't pay your bills with money that's owed to you that's still in other people's bank accounts. And I see it all the time. I once was talking with a client and they literally had over $1 million in accounts receivable.
Yikes.
It was scary. And you think to yourself, well, that's not that big of a deal. I mean, it was a $10 business. You would think it shouldn't be that big of a deal. But they were running on sub 5% margins. So if we do quick head math, if you have over 10% of your earnings for the whole year trapped in accounts receivable and you're running on sub 5% margins, that's a 5% divide that you just have to get out of somewhere, which usually is debt.
Right.
And debt money isn't free, and debt actually hurts your cash flow, not helps, because then you get that money, right? You can use it, but then you have to service that debt and pay it back.
How long was it taking them to collect payment, I guess? Because that's the key, right? If you have $1 million in AR, but like your average collection is, that's rolling over every 30 days, maybe that's not so bad.
Now, some of it had been owed to them for years because it was retainage.
Okay.
So they were doing large projects, and with a lot of retainage, that a lot of companies will keep, 10% back until the end of the entire project. So if you're on a project and you're on a beginning phase of like a 3-year project, you're not going to get paid for 3 years, which if you have correct profitability and correct cash flow is not that big of a deal, because then it just becomes kind of your profit distribution at the end. But when your profitability is less than that retainage amount, that means that you are having to fund that somehow.
Right.
Because that's your profit plus some of your expenses, because your profit was less than 10%. So cash flow is how much money is flowing in and out of your bank. And actually on your QuickBooks, there's another report that no one looks at except me, because I'm obsessed with it. And it is called the Statement of Cash Flows. And it literally shows you every dollar that came in and then where it went. So if you're ever looking at your profit and loss statement and it shows that you made a ton of money and you're like, well, I have no money in my bank, where did my money go?
Right.
Your statement of cash flows will tell you. It tells you all about debt servicing. So when you pay, so say you have a truck loan and you pay that loan, most of that loan, everything that's towards the principal, doesn't go against your profit and loss. That's not a deductible expense, only the interest. So if it was, say, a $1,500 car payment and only $250 of it was interest, the $1,250, that's $1,250 that's considered income, even though it's not money in your bank.
It seems like it's money in your bank, but it's not, because it's paid out and you can't write it off. So
Exactly.
Okay.
Yeah. So on your profit and loss statement, it will show as profit,
right.
but it's money that's gone. So that's why I like that statement of cash flows, because it'll show you that.
Okay.
Any money you pay yourself as a distribution. So if you take money out and you're like, oh, I'm just going to give myself a distribution of $2,000. Obviously, that's not an expense. That's money you paid yourself. That's profit.
That's income. I mean, that is money in your bank.
Yeah, but it's money that came out of your business bank into your personal bank. So it's no longer there. And so a lot of times that will get bloated and people won't really be paying attention to their distributions. And they'll be like, where did my money go? It's like, well, it went to distributions and then you spent it all on your personal expenses.
I've seen some businesses have some confusion on saying that they don't pay themselves, but they pay their personal bills out of their business account. That is paying yourself. I mean, if you're paying personal bills out of your business bank account, that becomes income, right? Because if it's like a non-deductible, yeah, if you're paying your home mortgage out of your business account, that is income that you've earned.
Yes.
Minus whatever, getting out of the weeds, but minus whatever you can claim on your taxes for business use of home.
Yeah, I always say to people, if this was just a job, would your employer pay this for you? If your employer isn't giving you a phone, if your employer isn't paying your mortgage,
Right.
if your employer isn't paying your car payment, then those are all part of your wage.
Yeah. So that's income. I mean, that's just separate kind of clarifying factor,
Yeah.
because I have heard business owners say, well, I don't even pay myself. How are your bills getting paid? Oh, well, I just pay them out of the business account. That means that's money you've earned from the business that came out of your business to pay your personal lifestyle.
Yeah, 100%. That would be part of your, what they call seller's discretionary earnings.
Yes. So yeah, I think a lot of small business owners, especially, they look at these reports, right? They look at these balance sheets and they see on paper, look, my business is making all this money. I don't know where it's going. And so maybe let's talk a little bit about, okay, so what do you do to help that situation? How do you get away from that feeling of like, on paper, my business is making a lot of money. I always feel broke. My business account is not like booming with, how do we churn some of that? Do we pay off some of the debt in order to increase that profitability? What are the steps? I mean, if you see that on a balance sheet, on a profit and loss statement, what do you recommend in those cases? I mean, obviously it's going to be case by case, but some quick scenarios.
The first thing I do is I look at the actual cash bills every month. So, and I have a spreadsheet now that I create for my clients. It's all about cash flow week by week by week by week. Like I have a client who, when we first started working together, he had 4 months worth of his receipts in accounts receivable. As business owners, we want to be data driven, right? And I know, like, especially financial data can feel so overwhelming and feel so confusing. And that's why it's easy to get into a cash flow conundrum where you're like, okay, where did all my money go? But that's why I like to create systems and create things that are easy to use so that you can figure out the answers to these questions with your own data, but not have it be confusing or be complicated.
Understanding the numbers is huge, because not everybody does. And we've talked about this time and again. Most people who start businesses are not typically entrepreneurs. They start a business because, a myriad of different reasons, but they don't understand the numbers behind. They don't understand the reports. They may understand that they need a bookkeeper, or they may bookkeep themselves, and they may have access to these reports, but then they pull them out and it's a spreadsheet full of numbers.
Yeah.
And what does that mean? What is this? So really understanding and digging deep, or at least having somebody to help you understand what these numbers are telling you, is going to be the very big difference in how quickly you're able to scale. I mean, otherwise it's trial and error, which is how most of us operate.
Yeah.
So
I like looking at the cash flow too, because you can do what I like to call backwards goals, where you're like, okay, I want to buy this, I want to buy this, I want to hire this person. You're like, okay, well, how much does that all cost? It's like, okay, well, if we've determined how much that all costs, then how much do we need to sell to actually be able to have all those things? So a lot of times, when people are like creating sales goals and things like that, they just throw numbers out there.
Right.
I'm like, where did you get this goal? They're like, well, it just sounded good. It sounded like the right goal. And it's like, well, I like to look at it the other way. It's like, what do we want to achieve at the end of the year? What do we want to have going on? And how much does that cost? So we can go backwards and say, okay, if we want to have these profit margins, we want to have all these things, then how much does that actually look like in terms of our billables?
Right. Well, going back to most people, which are the opposite. They're emotional thinkers, right? They're emotional when it comes to purchasing or even running their business, but you're talking about they can go one of two ways, right? Like, well, I want this new thing. I can't afford it. We can't really afford it. We probably really shouldn't buy that, or we really won't ever be able to afford it. Or they're like, I want this. I'm going to buy it because I think this is what I want for my business. I'll figure it out. What you're talking about is the rational, like, all right, I want this. Can I afford it right now? Then you dig in. Okay, actually we can. Or maybe we can't. Okay, how can we? What do we need to do differently? Okay, we need to increase our profits by X amount to make this worth it. Now you start to go backwards. Okay, if I want to profit X amount, that is X amount of sales. Okay, well, how many calls do I make per sale? Okay, well, it takes me 4 calls to close 1 sale. So now I need to, so then you start running your numbers backwards, and then okay, well, how many leads do I have to throw out there before I get a call? And then you get,
how much money do I have to spend to get leads? You can go all the way back from literally how much money you want to profit at the end of the year and make yourself all the way back to how many leads you need.
It's all trackable.
It's completely connected.
That's why people like yourself are big on tracking things, because they know the more you track, the more you understand. And you can see where your weak points are. First of all, that's another piece of it. You can see where your weaknesses are, and you can work on improving those. But even as it stands, even if you're closing 25% where somebody who's better at sales may close 50% of the calls that you take, doesn't even matter. You could stick with the numbers you have now and know how to backtrack that to know, okay, well, here's how many leads I have to pay for, or here's how many calls I have to make in order to get to the number that I want to reach. And then you can work on improving those numbers to make the same amount of purchased leads. And that's going to improve the number of calls you make. And then you're going to close more of them. And you can increase your profits spending the same amount of money by improving those systems or those skills within those systems. So it becomes very good. And this is why tracking numbers is so important in business.
Well, and especially your cash numbers, because if you're not tracking like where you're spending your money, it's very easy, especially in the trades, to just overspend your estimate every single time. But so many times I see people just overspend that. Like literally cost of goods sold management, or their supplies and their materials or subcontractors, is the number one thing I see as the ticket to you being profitable or not.
Yeah, that makes perfect sense. I mean, an estimate's only that, right? It's just an estimate. If that estimate is short by 20% every single time you do that job, then every single time you do that job, you're making 20% less than you expected. And if your profit margins are 30%, well, now you're working on a 10% margin for that particular job every single time you do it.
The book Profit First talks about this a lot, but it's called Parkinson's Law. And what it says is that as humans, we will use up whatever's available. So it's the same reason that if you give yourself 6 months to do a task, it takes you 6 months. But if you give yourself 6 weeks, it takes 6 weeks. It's not because you became magically faster. It's because whatever deadline we set to things, we have a tendency to want to achieve. But if we make it a larger deadline, then we just use it up.
Sure.
The exact same thing happens in money. It's the same reason we have what they call lifestyle creep.
I lived my 20s like that, right? Making good money, and you're like, okay, great. Well, now I'm making this. Okay, well, now I can afford a nicer place. Well, now I can actually get a new car. Now the insurance goes up. Okay, now
all the things.
You just find the ways to spend that additional money. And you're still okay because all your bills are getting paid, and but
it's the reason the profit first system works, where you're just taking that money out beforehand because then it's not available to you. It's the reason that in like pre-tax 401ks work.
Yeah, and that's where like you said, that's where the two teams need to be communicating, right? They need to, hey, here's what we're using as our estimate. Is this accurate?
Yeah.
And they can say, oh, well, we don't need this, and you're way short on this. Let's adjust these things. And then, and then they go back. Okay, well, we'll start using this as our estimate. And then you have to revisit periodically to make sure the cost of materials hasn't gone up, or whatever the case is. You need to revisit those things frequently. I'm not talking every week, but I'd say once every 6 months, once a year, just to make sure that those estimates are falling in line. Or if you start to notice the numbers start to change, then you say, hey, something's off here. We need to go back. What did you use for an estimate on this? Oh yeah, we forgot to tell you the cost of this went up by 20%. So now we need to adjust that on our estimates so that we're not overspending our budget all the time and blowing our numbers. All these are just words. It's the actions behind them. It's the actual systems behind them that make it all happen. You can't just say that I'm doing this thing and that's what it is now. Like, I'm saving.
But just creating that constraint. So really flowing through those estimates. And you could do the same kind of thing that we were talking about at the beginning with the cash flow document. You can do the same thing with your estimates. This is your labor. This is your overhead. Okay, then talk to your production team. Okay, this is the budget for this job, and have them updating that budget and letting you know what's going on. If something goes awry, let's be proactive about it. How do we mitigate something going awry? How do we decide?
Well, and use those jobs that didn't go awry to say, okay, we estimated, everything went according to plan. How much did we spend? Audit this every period, periodically audit it. How close was our estimate to the actual cost?
Yeah.
How long did we allocate for this job to be done? How long did it actually take? Why? Why did it take too long? Or, oh, we finished this quicker than we thought. So sometimes it's a positive thing. Sometimes we gave you 2 weeks to complete this job. Actually only took us 6 days. Great.
Yeah, well, then you can go on to the next job sooner, and then you can make even more money.
Right.
Right? Because every single day you're on a job is overhead. You have a set overhead every day, no matter what. And so some people will do overhead percentages. I don't agree with that, because to me, if a smaller job is going to take, say, 3 days, but it's a smaller job, then you need to add more overhead. Overhead percent, I like a flat rate per day.
Sure.
But that's something that I will argue with humans over all the time. Way we should do this, you should add something in so that you're really making sure that you have the cash flow, and just making sure that you're collecting on time, and then you're paying your suppliers on time so you don't get in a hole, and you're really looking at, okay, how is the money coming in and out? And if I put more money in, more sales in, am I actually going to get more money out? Because like my example of my client who had, the 4 months of accounts receivable, he was at a place where the more he sold, it actually hurt his cash position because he was having to fund it for so long.
Right, because he's fronting that money and it's taking too long to collect.
So if he sold $100,000 in a month, if he got to a place where he's selling $100,000 a month, that's $400,000 he had to fund, versus $50,000 a month is only $200,000.
Right.
So it was actually costing him money. So he was what I like to call growing broke.
Yeah.
And that's a really difficult position to be in. So just looking at your numbers and really saying, okay, where are we at? Where are things? And if you don't understand them, getting help and having somebody kind of walk you through it, because it's not what I know now. I did not know 10 years ago.
Right.
But yeah, just reach out, get help, and have someone, like myself, walk you through things and show you all of the fun things that can be cash flow.
Yeah, I mean, this is a very, very important topic, one we will definitely revisit in the future. If there's a more important topic to a business owner, I'm not sure what it is. This is the key. This is how a business is either viable or it isn't. This is why certain businesses succeed where others fail in the same exact space, because of that cash flow, because of that profitability. That's the differentiator for how you succeed. So great topic. Like I said, definitely one we'll revisit again. Definitely stay tuned for more on that, because I'm sure we'll be revisiting that one over and over.
I can't help myself. I'll talk about cash flow all day.
Yeah.
Okay.
Awesome. Well, thanks for tuning in, and we will catch you guys on the next episode.